The average American retires at 64. The average Gen Z person is 23 right now. That means you have roughly 40 years to figure this out. 40 years sounds like a lot of time until you do the math and realize that the entire system you were told to use, the job, the 401k, the compound interest, the just save 15% of your income advice was designed for a world that stopped existing before most of you were born. Social Security will be functionally insolvent by 2033. That is not a conspiracy theory. That is the Social Security Administration's own projection. The pension gone. Company loyalty gone. The median Gen Z worker has changed jobs 3 times before turning 25. And the median Gen Z worker is also, by the way, paying 39% more for rent than millennials did at the same age, adjusted for inflation. So, you are running. You are genuinely running. You are working harder, switching faster, hustling more. But here is the question nobody's actually asking. What if the floor itself is moving? We are going to explain exactly how the retirement machine works, why it was never really built for you, and why the advice your parents give you about money is not just outdated, is actively pointing you in the wrong direction. The central metaphor I want you to hold on to for this entire video is a conveyor belt. Not a regular one. One that moves backward, slowly at first, then faster. And your entire financial life is you walking on that belt trying to move forward. Now, here is the thing. Most people do not even know the belt is moving. They think they are making progress because they are walking. They look down at their feet. They see movement. They feel tired. They feel like they are working. And they are. But the belt is eating the distance. And the longer you do not understand this, the more the belt speeds up. Let us start at the beginning. There are 2 types of people in this conversation. The first type hears Gen Z will never retire and thinks it is doom content, rage bait, pessimism. They close the tab, go back to TikTok and feel vaguely annoyed. The second type hears it and thinks, okay, if that is the constraint, what does that change about how I should behave right now? This video is for the second type, not because you are smarter, because you are asking a different question. And in money, the question you ask determines almost everything. So, let us ask the right one. Why is retirement broken for Gen Z specifically? And what does the actual math look like? Here is what the retirement system was built on. It was built on 3 assumptions. Assumption 1, you would work 1 or 2 jobs your entire career, and those jobs would offer a defined benefit pension. Assumption 2, Social Security would supplement that pension in a meaningful way because the ratio of workers to retirees would stay roughly stable. Assumption 3, your cost of living would increase gradually and predictably, meaning a modest savings rate compounded over 40 years would be enough. All 3 of those assumptions are now wrong. Not slightly off, structurally wrong. Let me do the math slowly because I want you to actually feel this. In 1980, the worker to retire ratio in the United States was roughly 3.2 to 1. For every retiree drawing from Social Security, there were 3.2 workers paying in. Today, that ratio is 2.8 to 1. 8:1. By 2040, it will be 2.3:1. That might not sound dramatic, but it is the difference between a system that functions and one that does not. Social Security was not designed as a savings account. It was designed as a transfer payment. Money moves from current workers to current retirees, which means when you have fewer workers and more retirees, the math breaks. It is not political. It is arithmetic. The Social Security Trust Fund, the buffer built up over decades, is projected to be depleted around 2033. After that, the program can only pay out what is currently coming in, which means benefits would drop to roughly 77 cents on the dollar. For a Gen Z person retiring in 60, that assumes the program still exists in a recognizable form, which is a generous assumption. Now add the pension collapse. In 1980, roughly 60% of private sector workers had a defined benefit pension. A pension that guaranteed them a fixed income for life based on years of service. Today, that number is 11%. The rest got replaced with the 401k, a defined contribution plan, which sounds similar, but is fundamentally different. With a pension, your employer takes the investment risk. With a 401k, You take the investment risk and the market gets to decide what your retirement looks like, which fine, in theory, that is workable. Except most people do not optimize their 401k contributions, do not understand asset allocation, do not rebalance, and contribute inconsistently because life is expensive. The median 401k balance for Americans in their 30s right now is $21,000, not $210,000. $21,000, that is not a retirement. That is a slow-moving financial emergency. But here is where it gets interesting. And by interesting, I mean uncomfortable. The standard advice, save 15%, invest in index funds, let compound interest do the heavy lifting, is not wrong. In theory, the math is real. If you invest $500 a month, starting at 22 at a 7% average annual return, you have roughly $1.3 million at 65. On paper, that works. The problem is not the math. The problem is the assumptions baked into the math. Assumption 1, you have $500 a month to invest consistently. The average Gen Z person in a major city is spending between $1,400 and $2,200 on rent alone. Entry-level salaries have not kept pace. A 22-year-old starting a job in marketing in 2026 makes around $42,000 a year before taxes. After federal and state taxes, health insurance, and other deductions, they are taking home maybe $27,000 a year. That is $2,250 a month. Subtract rent, groceries, transportation, student loans, and you are not investing $500 a month. You are surviving. Maybe the $500 a month scenario is not a realistic baseline for most of Gen Z. It is a ceiling. Assumption 2, you start investing at 22. Compound interest is violently sensitive to when you start. This is the part nobody communicates well. If you start investing at 22 and reach 1.3 million at 65, that is 43 years of compounding. If you start at 32, just 10 years later at the same rate and same contributions, you end up with about $650,000. You lost more than half your outcome by waiting a decade. The problem is that your 20s are now the most financially hostile decade in modern American history. High rent, student debt, stagnant entry wages, an economy where junior roles are disappearing to automation. All of it conspires to prevent you from investing early. The conveyor belt is moving fastest when you are weakest, which is when you are young. And it slows down a little when you are older and more established. But by then you have already lost years of compounding. This is not an accident, by the way. This is just how the timing works. But understanding it changes what you prioritize. Now, you might be thinking, okay, but what about the gig economy, the creator economy, entrepreneurship? Is not this generation the most entrepreneurial in history? Yes, kind of. But here is the problem with that framing. When a 24-year-old drives for a ride-share app and calls themselves an entrepreneur, the platform gets the pricing power, the customer relationship, and the data. The driver gets the car depreciation, the gas, the insurance, and no benefits. The platform took the traditional employer-employee relationship and restructured it so that the worker absorbs all the risk and the company absorbs all the upside. That is not entrepreneurship. That is a dressed-up version of being an employee except with worse protections. And a huge chunk of Gen Z's income comes from this category. Which means not only are they earning less predictively, they are also not building Social Security credits efficiently. They are not getting employer-matched 401k contributions, and they have no sick leave, no parental leave, no nothing. The gig economy did not create opportunity. It created the appearance of flexibility while quietly dismantling the financial infrastructure that made retirement possible for previous generations. This is a good time to pause because I realize I am saying a lot of things that sound like doom, and I want to be precise about what I am actually arguing. I am not saying Gen Z is doomed because of laziness or bad choices. I am saying the machine was designed for a different set of inputs and you are feeding in different inputs, so the output is broken. That distinction matters because it changes where you apply pressure. Here is the real trap. The retirement machine has 4 failure modes specific to Gen Z, and most people are stumbling into all 4 simultaneously. Failure mode 1, purchasing power erosion. Failure Mode 2, Timeline Compression. The window for compound interest is shorter than it looks because your investable income arrives late. Failure Mode 3, System Dependency. You are told to rely on systems, social security, employer benefits, housing appreciation that are structurally weakening. Failure Mode 4, Lifestyle Inflation. Your spending expands to match your income before your assets can generate returns. Let me go through each one because each one is its own version of the belt speeding up. Purchasing power erosion is the sneaky one. Inflation is not just prices going up. Inflation is the silent theft of future purchasing power from the money you have saved today. If inflation averages 3% annually, which is conservative given recent history, $1 today is worth about 41 cents in 30 years. That means if you have $100,000 saved at 30, and you do not invest it, you effectively have $41,000 of purchasing power by 60. The number stays the same. The value evaporates. This is why keeping money in a savings account is not neutral. It is actively losing. The belt is moving. But here is where it gets weirder. Even index fund returns, which average around 7 to 10% annually before inflation, are not what they used to be. Historical returns from 1950 to 2000 were propped up by a very specific set of conditions. Massive population growth, post-war industrial expansion, globalization unlocking cheap labor and new markets, and technology multiplying productivity in ways that had never happened before. Some of that is still ongoing, but the biggest tailwinds are slower now. Demographics are aging globally. Globalization has plateaued. Productivity growth from technology is happening, yes, but it is also accompanied by structural unemployment in categories that used to support middle-class retirement. Future expected returns on equities over the next 20 years are generally estimated lower by most serious analysts. Somewhere between 5 and 7% nominal after inflation, that is 3 to 5% real, which is still okay but is not the historical numbers your parents used to build their projections. Failure Mode 2, Timeline Compression. This one is subtle but is probably the most damaging. The standard retirement model assumes you start investing meaningfully in your mid-20s, but most Gen Z people are not in a financial position to invest meaningfully until their late 20s or early 30s. Student loan payments, high rent, lower starting salaries relative to cost of living. If the average Gen Z person starts real investing at 28 instead of 22, they lose 6 years of compounding on every dollar. 6 years does not sound like a lot, but run the math. $600 a month from 22 to 65 at 7% is $1.5 million. Starting at 28, same contribution, same rate, $1.01 million. You lost nearly $500,000 not by doing anything wrong, but just by starting 6 years late because the economic conditions of your early 20s made it structurally impossible to start earlier. And the even darker version of this for Gen Z in high cost of living cities, New York, San Francisco, Seattle, Austin, the delay is not 6 years, it is 10 or more. I know people in their early 30s with six-figure salaries who are still not investing consistently because their rent is $3,000 a month. Their student loans are $800 a month, and they feel like they are always one bad month away from chaos. They are doing everything right by conventional standards. Good job, responsible spending, some savings, but the timeline has been compressed so severely that the old math does not apply and nobody has told them that. They still think they are on track because they have a 401k they barely contribute to. They are not on track. The belt is moving and they think they are standing still. Failure Mode 3, System Dependency. Let me tell you about a guy, call him Marcus, not a real person, composite of patterns I have observed. Marcus is 27. He has a solid job at a mid-sized tech company. He contributes 6% to his 401k because his employer matches up to 6% and someone told him to always get the full match. His apartment costs $1,900 a month. He has $34,000 in student loan debt. He is planning to buy a house in the next few years because his parents told him that is how you build wealth, that real estate always goes up. He is pretty confident about retirement because he has a 401k and he plans to eventually own a house that will appreciate. Here is what Marcus has not accounted for. His 401k holds $12,000. At 6% contribution on a $72,000 salary, he is putting in $4,320 a year. That grows, sure, but it is not meaningful until his late 40s, which means he is 40 years old before compound interest really starts doing heavy lifting. The house he wants to buy will cost around $450,000 in his city. He has $11,000 saved for a down payment. He needs $90,000 for a conventional 20% down payment to avoid private mortgage insurance. He is 9 years away from having that down payment at his current savings rate, assuming nothing else goes wrong, which it will. Meanwhile, rent continues to rise, student loans continue to drain, and his real investable surplus is maybe $200 to $300 a month. He is depending entirely on 3 systems: Social Security, the 401k, and housing appreciation, all of which have structural problems he has not examined. Marcus is not stupid. Marcus is a victim of a financial education system that taught him to follow a map that was drawn for a different terrain. He is following directions to a destination that has moved. This is the conveyor belt problem. You can be disciplined, hardworking, following all the conventional advice and still not be moving forward because the floor is moving under you. If you are finding this useful and you are the kind of person who actually wants to understand how money systems work instead of just consuming motivation content, then subscribing makes sense. I put out one of these per week. Every single one is built around a specific mechanism, not a vibe. That is the whole point. Failure mode 4, lifestyle inflation. This is the one people are most reluctant to hear because it is the one that involves behavior rather than structure. The other 3 failure modes are systemic. This one is psychological, but it is real and it compounds every other problem. Human beings have an extraordinary ability to expand spending to meet income. It is not weakness. It is how we are wired. When income goes up, the immediate instinct is to improve comfort. Better apartment, better car, better food, better travel, better everything. This is called lifestyle inflation and it is almost universal. The problem is that lifestyle inflation destroys the marginal dollar. Every dollar of lifestyle inflation is a dollar that cannot compound for 30 years. And the psychological research on this is pretty clear. People consistently overestimate how much happiness new spending will generate and underestimate how quickly they adapt to a new baseline. The $500 a month apartment feels cramped. You upgrade to a $1,000 apartment. Within 6 weeks, the $1,000 apartment is your new normal, and you want more. The initial happiness spike is temporary. The expense is permanent. For Gen Z specifically, this is amplified by 2 things that did not exist at the same intensity for previous generations: social media comparison and the collapse of social infrastructure. Social media creates a curated, relentless stream of other people's lifestyle peaks. The travel, the restaurants, the apartments, the aesthetics. You are not comparing yourself to your actual peer group. You are comparing yourself to the most aspirational version of dozens of different peer groups simultaneously. The psychological pressure to spend on lifestyle is higher than it has ever been because the benchmark you are comparing to is artificial and infinite. And the collapse of social infrastructure, third places, community spaces, cheap social options means that spending money is increasingly the primary way to socialize. The free park is there, but the coffee shop, the bar, the restaurant, the concert. These are where the social life happens now. And that cost money. It is not just vanity spending. It is often genuinely social spending, which makes it harder to cut without real social consequences. The result is that the marginal dollar, the dollar above survival expenses, gets absorbed by lifestyle before it can become invested capital. And that marginal dollar is where all the compounding happens. Lose the marginal dollar to lifestyle inflation, and the math breaks permanently. Now, let me be honest about something because I think this video risks sounding like a lecture and I do not want that. What I am describing is not a personal failure. This is structural. The system is designed to extract that marginal dollar. The subscription economy exists to capture recurring payments from your marginal dollar. The experience economy, go somewhere, do something, share it, exists to capture your social spending. The upgrade cycle in tech, fashion, cars, housing, All of it is designed to absorb your surplus before it compounds. This is not paranoia. These are just incentives. Companies optimize for capturing your next dollar, and they are very good at it. Understanding the machine does not make you immune to it, but it changes how you interact with it. Here is a short story that I think illustrates this better than statistics. Two people graduate the same college in the same year with the same degree. Both get jobs paying $58,000 a year. Same starting point. For simplicity, let us say they both live in the same city with roughly the same cost structure. Person A treats the job as a starting point. He invests aggressively $800 a month into a simple index fund portfolio from day one. He rents a modest apartment with a roommate to minimize fixed costs. He does not have a fancy social life, but he is not monastic either. He drives an old car. He is comfortable, but not impressive. By 30, he has invested nearly $90,000 with compound growth at 7%. That base has already grown to around $115,000. Person B gets the same job, but treats the salary as a permission slip to live the life he imagined. Nice apartment, solo, car upgrade, leased, travel, dining out, subscriptions, a gym that he uses occasionally. He saves around $200 a month inconsistently. By 30, he has about $12,000 in a savings account and $6,000 in a 401k. He never thinks about. He does not feel irresponsible. He feels like he is enjoying his 20s, which is what he was told to do. Fast forward to 40. Person A, through consistent investing and some career advancement that allowed him to increase contributions, now has around $380,000 invested. Person B, after finally getting serious in his mid-30s, has around $80,000. The gap is $300,000. But here is the real gap. At a 7% return, Person A's $380,000 becomes over $1.4 million by 65 without adding another dollar. Person B's $80,000 becomes around $500,000 under the same conditions, and he has to add more aggressively, which he may or may not do. The decision made in the 20s, $800 a month versus $200, resulted in a gap of nearly $1 million at retirement. Not from income differences, not from intelligence differences, from the timing of deployment of the marginal dollar. This is the conveyor belt in concrete form. Person B was walking, just not fast enough. The belt swallowed the distance. Now, there is a real objection I want to address here because I can already hear it. Okay, but housing is the real wealth builder for previous generations. Even if everything else is broken, home ownership builds equity, and that is how regular people got wealthy. This is the most durable piece of conventional wisdom in personal finance, and it deserves a serious examination rather than a dismissal. Here is the honest answer. Housing appreciation has been real and significant for people who bought homes in the right decades. Someone who bought a house in 2002 in a major metro area and held it through 2022 saw enormous appreciation. That is true. But there are several reasons why housing does not play the same role for Gen Z as it did for boomers in early Gen the 10th. 1. The entry cost has become structurally prohibitive. The median home price in the United States in early 2026 is around $420,000. To get a conventional loan with 20% down, you need $84,000 in cash, plus closing costs of roughly another $10,000 to $15,000. That is nearly $100,000 in liquid capital required to enter the housing market at the median level. The median Gen Z household has around $8,000 in savings. The gap is not small, it is generational. It is the difference between the starting line being in the same county or a different country. 2. Mortgage rates. For most of the 2010 decade, mortgage rates were between 3 and 4%. People who bought houses at 3–12% are sitting on structurally subsidized housing. They are not paying market rates for debt. They are paying rates that no longer exist. If you buy a $420,000 house with $84,000 down at a 6.5% rate on a 30-year mortgage, your monthly payment is around $2,112. At a 3–12% rate on the same house, the payment would have been around $1,492. That $620 monthly difference over 30 years is $223,200 more paid for the same house. The people who locked in low rates built wealth through housing. People entering now are inheriting the peak of a cycle. 3. Housing appreciation going forward is not guaranteed to replicate historic rates. A significant portion of the appreciation in the 2010 decade was driven by the combination of artificially low interest rates, demographic demand from millennials hitting peak home buying age, and supply constraints from restrictive zoning. As interest rates normalize and demographics shift, the tailwind is weaker. That does not mean housing is a bad investment. It means it is a different investment than your parents experienced, with different risk-reward characteristics. 4. The opportunity cost argument. The $100,000 required to enter the housing market could, if invested in equities over 25 years at 7%, become around $540,000. Home ownership also has costs that do not compound. Maintenance, property taxes, insurance, interest on the mortgage that reduce the effective return significantly. There is a real scenario depending on location and timing where renting and investing the difference generates more wealth than buying. This is not a universal argument. It depends on the city, the timing, the duration of ownership. But it means the just buy a house advice is much more contextually dependent than it sounds. Want to throw in something here that I think most people genuinely do not think about when it comes to retirement. The psychology of retirement itself is changing, and it is changing in a way that makes the financial math even harder. Previous generations had a clear finish line. You worked. You retired at 65. You collected a pension in Social Security. You had a defined endpoint and everything was optimized toward reaching it. Gen Z does not have a defined endpoint, and that ambiguity creates planning paralysis. If there is no clear destination, the journey feels pointless to optimize. Why sacrifice your 30s to optimize for a retirement that might not look like what you imagine, using systems that might not function as advertised toward a timeline that feels impossibly distant? The psychology of delayed gratification requires a clear, believable reward at the end of the delay. When the reward is vague, the delay feels irrational. This is why just save more is such ineffective advice. It is not ignorance holding people back. It is a legitimate psychological obstacle rooted in the collapse of the traditional retirement narrative. The narrative was suffer now enjoy later system delivers. That narrative has broken down. The system looks unreliable. The later looks murky. And so the rational behavioral response is forget later, live now, which emotionally makes complete sense, which is also financially a disaster. The question then becomes, what is the alternative framework? If the traditional model is broken, what actually works? This is where I want to be careful, because I do not want to replace one oversimplified narrative with another. There is no single answer, but there are a set of principles that when combined actually address the structural problems rather than pretending they do not exist. Principle 1. Stop optimizing for retirement and start optimizing for income independence. These sound similar, but they are different targets. Retirement is a date-based goal. Reach a number by a certain age and stop working. Income independence is a flow-based goal. Generate enough passive or semi-passive income to cover your expenses without requiring active employment. The second goal is achievable at any age, does not depend on government systems functioning, and can be pursued with smaller amounts of capital through different mechanisms. Aiming for income independence by 45 is a more tractable and more resilient goal than aiming for retirement at 65. Principle 2. The marginal dollar is the variable that matters most. This is not just about saving more. It is about what you do with the dollars above your survival threshold. If your monthly expenses are $2,500 and you earn $4,000, you have $1,500 of marginal dollars. The question is whether those dollars go into lifestyle inflation or into assets. Not all at once. I am not saying live like a monk, but understanding that marginal dollars have compounding potential and lifestyle spending does not changes how you think about trade-offs. A $200 monthly subscription feels small. Over 10 years at 7% compounding, the capital not invested because of that subscription is around $34,600. I am not saying cancel everything. I am saying understand the actual cost of convenience spending in terms of future capital, not monthly charges. Principle 3. Skill compound faster than capital for the first decade. This is the one that sounds like motivational content, but is actually just math. In your 20s, a 20% salary increase from skill development generates more investable capital per year than a 20% return on whatever small amount you have invested. If you have $20,000 invested and earn 20% in a year, you made $4,000. If you earn $60,000 and get a $12,000 raise from skill development, you just increased your annual investable capacity by potentially $8,000 per year every year going forward, which compounds as capital. Investing in skills, leverage, positioning in your 20s is not soft advice. It is capital allocation strategy. The question is just which skills, not passion-based, interest-based skills, market-based skills, skills that are scarce relative to demand, that are difficult to automate, and they exist in industries with pricing power, data science, software development, sales at a high level, financial analysis, legal specialization, certain types of medical specialization. These are not the only options, but they are the structural types. Principle 4. Understand the difference between assets and liabilities disguised as assets. The car you bought on a loan is not an asset. It is a liability with a depreciation schedule. The house you bought with a 30-year mortgage at 6.12% in 2026 is a partial asset and a partial liability. Equity builds slowly while interest consumes a huge portion of early payments. A rental property that generates cash flow after expenses is an asset. Stock index fund positions are assets. A business that generates revenue without requiring you to be present is an asset. The simplest possible asset portfolio for a 20-some who is just starting. A high-yield savings account for a 6-month emergency fund. A maxed 401k if there is an employer match. And a Roth IRA maxed annually invested in low-cost index funds. That is it. That is the baseline. Not complicated, not sophisticated, just consistent and tax efficient. Now, here is the second-order insight. The thing most people miss completely. The real problem with Gen Z retirement is not that the math is hard. The real problem is that the math requires a different setup than the one most people have. The conventional setup job 401k house Social Security done requires the system to function as advertised, and the system is breaking. But a different setup income from multiple sources, lower fixed costs, invested assets generating passive income, skills that command above average rates can actually work even in a broken environment. The belt is still moving, but if you understand the belt, you can run faster or find a way to step off it entirely. A quick aside, I love how retirement advice has evolved from just save and invest wisely to build a personal brand, monetize your passion, and hustle across multiple income streams simultaneously while also having excellent mental health. It is like if a structural engineer looked at a collapsing bridge and said, "Have you considered becoming more resilient as a person?" Yes, very helpful. Thank you. The structural framing matters because it tells you where to apply leverage. If the problem were purely behavioral, people are not disciplined enough, not motivated enough, not smart enough, then behavioral solutions would work. Save more, spend less, stay consistent. But if the problem is structural, the system itself generates worse outcomes for the same inputs, then behavioral solutions are necessary but insufficient. You need both structural insight and behavioral discipline. And most retirement advice gives you only one or the other. Let me talk about the housing trap more specifically because I think it is the most psychologically powerful trap for Gen Z. Home ownership is deeply emotionally loaded in American culture. It is tied to stability, adulthood, family formation, community belonging, financial credibility. When you rent, there is a subtle social signal. You are not settled. You are not committed. You are not there yet. This social pressure is real and it influences financial decisions in ways that people do not fully acknowledge. People buy homes before they are financially ready because the social cost of not buying feels higher than the financial cost of buying. And the financial cost of buying at the wrong time at too high a rate with insufficient capital in a market at the peak, that cost is enormous and often not recovered for a decade. There is a pattern I have noticed. It goes like this. Someone in their late 20s feels the social pressure to buy a home. They are not financially ready. Insufficient down payment, high existing debt, mediocre credit, rates that make the monthly payment stressful. But they do it anyway because the cultural narrative says this is the right move. They buy, and for 2 or 3 years things are tight, very tight. The mortgage payment, property taxes, homeowners insurance, and inevitable repairs consume basically all the marginal dollars that could have been invested. They build a small amount of equity, but the opportunity cost, all those marginal dollars not compounding in the market, is substantial. Then something happens. Job change, life event. They have to sell earlier than planned. And they discover that after 5% real estate agent commissions and a few years of primarily interest mortgage payments, they have built almost no real equity. They are back to renting. But now they are 33, not 27. And the capital they could have been compounding in equities has been sitting in a house that appreciated modestly, if at all. The belt ate 5 years of progress. This is not an argument against home ownership. This is an argument against home ownership at the wrong time for the wrong reasons with the wrong financial structure. The same asset, a house, can be a wealth builder or a wealth destroyer depending entirely on the conditions under which you buy it. And here is the thing. I am 20 years old. I have been thinking about this stuff since I was 16. And the single clearest pattern I have identified is this. The people who built real wealth quietly did not follow the cultural script. They made decisions based on math and structure, not on what looked right socially. They might have rented longer than felt comfortable. They might have stayed in a less prestigious job to maintain lower fixed costs while building investment positions. They made decisions that looked slightly weird from the outside but were internally coherent when you understood their model. The people who followed the cultural script, job, mortgage, 401k minimums, nice car, often looked financially successful from the outside while being one layoff away from crisis. Another brief detour because this matters. You might be thinking, okay, so what about the people who invested in crypto or built an online business or got into real estate early? Are those not just luck? Sometimes yes, but not usually. The pattern with people who built real wealth outside the traditional system is that they identified a structural opportunity, a mispricing, a gap in the market, a leverage point before it became obvious, and then had the conviction and positioning to act on it. That is not the same as luck. It is pattern recognition plus execution. Luck plays a role. Timing plays a role. But the underlying skill is seeing structural reality before the consensus does. And I genuinely believe that skill is learnable. It is basically what we are doing in this video. Let me give you the third escalation of this whole thing because it gets more uncomfortable from here. The problem is not just that retirement is harder for Gen Z. The problem is that the advice ecosystem has not updated, the financial advisory industry, the retirement planning industry, the content around personal finance. Most of it is still optimized for a world with stable employment, functional social security, affordable housing entry points, and low mortgage rates. The advice is not wrong exactly. It is just stale. And stale advice applied to a new structural reality produces the wrong outcomes with perfect precision. Here is what I mean. Standard advice says, invest 15% of your income. But if your income is $40,000, 15% is $6,000 a year. After tax, that might be $5,000 net invested. At 7% for 40 years, that is around $16000 at 65. That sounds workable. Except $40,000 in 2026 in any major American city is survival income, not comfortable income. Rent alone consumes 40 to 50% of gross income for a huge proportion of Gen Z. So the advice to invest 15% does not apply to the actual income and expense structure that most Gen Z people are operating with. It is advice calibrated to a different cost of living, a different income to expense ratio. And giving people advice calibrated to the wrong reality is more dangerous than no advice because it creates false confidence. I am doing everything right. You are not. The frame is wrong. The stale advice ecosystem also systematically underweights the role of income growth relative to expense optimization. Standard financial content is obsessed with cutting expenses. Coffee subscriptions, dining out. And yes, cutting expenses matters, especially for the marginal dollar argument. But there is a ceiling on expense reduction. You cannot cut expenses below survival. There is no ceiling on income growth. Theoretically, a $10,000 annual salary increase has more long-term impact than eliminating $3,000 a year in expenses, because the salary increase compounds forward and the expense cut does not. This is why skill development, income growth, and positioning in high-growth industries matter so much more than frugality in the early stages. Frugality matters for preserving the marginal dollar. Income growth determines how many marginal dollars exist. You need both, but the advice ecosystem overweights the former. Here is where this gets genuinely interesting. And by interesting, I mean the part that makes the whole thing click. The Gen Z retirement crisis is in a significant way an information asymmetry problem. The people who understand the structural reality, who understand that Social Security is deteriorating, that pensions are gone, that housing entry is prohibitive, that compound interest is time-sensitive, that the marginal dollar is the key variable. Those people are making different decisions. They are starting businesses earlier. They are investing in high-income skills aggressively. They are keeping fixed costs low even when lifestyle inflation pressure is enormous. They are building income from multiple sources rather than relying on a single employer. They are thinking about income independence rather than retirement. And they are doing this quietly without a lot of external validation because it does not look impressive in the short run. The people who do not understand the structural reality are following the old script. They are waiting for the cultural checkboxes: job, car, apartment, house, partner, 401k to deliver them to retirement, and the conveyor belt is eating their progress. Not because they are stupid or lazy, because they have been given the wrong map. This is the information asymmetry. The people who will be fine financially in their 50s and 60s are largely people who understood the structural reality in their 20s and made decisions accordingly. The information is not hidden. It is just not presented clearly and without the usual noise of motivational framing or doom framing, both of which make it harder to act clearly. And I want to say one more uncomfortable thing before I bring this to a close, because I think it is necessary. The traditional retirement narrative serves a specific set of institutional interests. Banks make money on mortgages. Financial advisory firms make money on retirement accounts they manage. Employers benefit from stable, long-term employees who are building toward a pension or retirement match rather than taking career risks. The government benefits from a population that believes Social Security will be there for them and does not demand immediate reform. None of these institutions are evil. They are just operating according to their incentives. But their incentives do not align with your individual financial outcome. The advice they produce: buy a house, contribute to your 401k, work steadily for 30 years, rely on Social Security, is genuinely good advice for the system's health. It is not necessarily good advice for your individual wealth outcomes in the specific structural environment of 2026. Attacking incentives, not individuals. The system is not malicious. It is just optimized for different objectives than your financial independence. Here is another brief moment of clarity. I love the phrase "just invest in index funds," as if the main challenge in building wealth is that people did not know about index funds. Yes, great. We know about index funds. The problem is having the capital to put in them at the right time consistently without life eating at first. The problem is behavioral and structural, not formational. Nobody is poor because they did not know index funds existed. They are financially stuck because the structural conditions of their lives make consistent investment difficult, and the advice they receive does not account for that reality. So let me bring this back to where we started, because the cold open asked a question and I think we owe it an answer. What if the floor itself is moving? It is. That is the conclusion. The floor is moving. The conveyor belt is real. The systems that previous generations relied on, pensions, stable long-term employment, affordable housing entry, functional Social Security, consistent equity returns, are all structurally weakening simultaneously. That is not doom. That is just the terrain. And if you know the terrain, you can navigate it. If you do not, you walk confidently in the wrong direction. 3 practical, non-generic things you can actually do. First, calculate your actual investable surplus right now, not what it should be in theory. Take your actual after-tax monthly income, subtract your actual fixed costs. What remains before discretionary spending is your marginal dollar pool. If that number is zero or negative, the first job is to restructure fixed costs before anything else. That might mean a roommate, a cheaper city, a different car, a different living situation. It is not glamorous. It is necessary. You cannot invest money you do not have. Identifying the actual number with clarity is more useful than any specific investment advice. Second, prioritize income growth over expense cutting for the first decade. Every year you are between 20 and 30. The most efficient use of time and energy is increasing what you earn, not minimizing what you spend. That does not mean spend recklessly. It means if you have 100 hours in the next 3 months, investing 80 of them in a skill that will increase your salary by $15,000 will generate more financial progress than spending those hours optimizing your budget to save $2,000 annually. Know which lever moves more. Skill investment, positioning in high growth sectors, building a professional reputation in a specific valuable niche. These produce compounding income, which produces compounding capital. Third, restructure your mental model of retirement. Stop optimizing for a number at age 65. Start optimizing for income that does not require you. That might be dividend income from a stock portfolio. That might be rental income from a property. That might be a business that runs without your constant presence. That might be royalties or licensing. The specific vehicle matters less than the structure. Passive or semi-passive income streams that cover your cost of living. If you can cover your cost of living without active employment, you are free. You do not need to wait until 65. You do not need Social Security to function. You do not need a pension. You are off the belt. Getting off the belt is the goal. The traditional retirement model puts the finish line at 65. Income independence moves that finish line to whenever the math works, which with discipline and structural clarity can be significantly earlier. The conveyor belt is real. It is moving. The question is whether you are walking on it pretending it is not, or whether you understand